I'm delighted to be joined by Caroline Sumner, Chief Executive Officer of R3, the Association for Business Recovery Professionals, for Christie & Co.'s Business Outlook, where we reflect on activity in 2023 and we look at what may be in store for 2024. Welcome, Caroline.
Thank you, Stephen, and thank you for inviting me today.
So, Caroline, the insolvency, restructuring and turnaround profession is a vital part of the UK economy. For those who may not be familiar with R3, the trade body for the profession, can you just cover what R3's key objectives are?
R3 was established over 30 years ago as the Trade Association for Insolvency and Restructuring Professionals. And today we've got over 3,000 members. They cover the broad range of everybody who works within the profession, including insolvency practitioners, barristers, solicitors, and those who work with and for the profession, including Christie & Co. and others. So we have some really key roles to play for our members. We support the profession, we promote and defend the profession. We support the profession by providing technical guidance and updates. We hold a range of training courses and conferences where our members can come together and share their expertise, and through that we can maintain the highest standards within the profession. We bring the profession together both nationally and regionally, and we organise a number of networking opportunities throughout the year, from dinners, briefings, all the way up to main conferences. And actually this year we've had over 5,000 people come to our events, which has been fantastic. We protect and defend the profession. Sadly, the work our members do is quite often misunderstood or unfairly criticised. So we respond to stories in the press, we provide briefings to journalists, we do submit consultation responses, and we lobby Parliament to ensure that the regulatory framework that we work within and the legislation that we have is fit for purpose. And finally, including today, we take every opportunity we can to promote the really valuable work that our members do.
So looking back at 2023, what pressing matters did R3 get involved with, and what's on the agenda for 2024?
It might come across as a little bit strange, but actually 2023 was mostly spent waiting. At the end of 2021, the government issued a really far-reaching consultation on the future of insolvency practitioner regulation. The proposals included getting rid of the current bodies of 4 recognised professional bodies that licence and regulate IPs, and they wanted to replace that with a single regulator that was sat within the Insolvency Service. They also wanted to introduce reforms and including firm regulation, a compensation scheme, change the way in which insolvency practitioners are bonded. And some of these reforms are really far-reaching, and as you can imagine, they really had the power to really change the way in which our members operate and are regulated. So we did a lot of work at the beginning of 2022, putting in the consultation response, and then we sat back and waited. By the end of 2022, we still hadn't had any response from government, and we fully anticipated it coming out at the beginning of this year. We set up a massive body of work to lobby, depending on what the results were. We had a lot of stakeholder engagement events planned. In the event, the outcome didn't come out until September of this year, which was a bit of a surprise, because when it did come out, actually, they'd done quite a U-turn, and instead of scrapping the current system of RPBs and introducing a new regulator, we were really pleased that they had listened to a lot of the responses, including our own, and had decided that actually the current system wasn't failing in any way to justify setting up a whole new regulatory regime. What else kept us busy during 2023? Well, the restructuring plans and moratoriums were introduced as part of the SIG Act in 2020, and I think they've really come to the fore this year. We've now had 22 restructuring plans, so we've been following the process of how they've been used, what the responses of creditors have been to those plans, and identifying whether there are any deficiencies in the current legislation or the way that they're being used. Insolvency appointments have been rising, so our members have been getting busier, so it's meaning that we are have been putting on a lot of courses and conferences to make sure that the profession remains up to date. And one of the issues which has kept us busy continually for about the last 5 years is HMRC and how HMRC engages with the profession. I think it's fair to say that in the move within HMRC towards much more digital processes and customers accessing all of their services online, the insolvency profession has been left behind a little bit. The insolvency legislation doesn't quite fit with the normal tax legislation, and our members have found it very difficult to access services in the way that normal customers are doing. We've been keeping a keen eye on the situation with Thames Water and Wilko, responding to press inquiries and promoting the work that our members do as a result on that. And we've also responded to another big consultation that the Insolvency Service put out earlier this year on the personal insolvency framework. So looking at where the gaps are, focusing on the options available to individuals, whether there are any bits that could be worked better or not. And that's been quite a big body of work as well. Looking forward to 2024, a lot of the consultation work will lead to further consultations from the Insolvency Service. They'll be really waiting to see what the detail about firm regulation is, how that's actually going to impact our members on a day-to-day basis. Because we do expect insolvency appointments to continue rising, we're going to be continuing with our campaign to encourage directors to seek early advice in order to maximise the opportunities for them to rescue businesses and companies.
You mentioned that you anticipated rising insolvencies and the profession would need to deal with that. And I think it's fair to say that 2023 was a year where we saw the highest level of insolvencies since the depths of the financial crisis. How has R3 and its members been helping and dealing with that?
I think it's fair to say our members have been really busy, saving businesses, safeguarding jobs, and really recycling the value of those businesses where they haven't been able to rescue them. There's been a really steep rise in inquiries from directors over the last year, and owners of distressed businesses wanting to seek help, and our members are always very keen to give advice and time to directors in that position. I like to think of insolvency practitioners as problem solvers. So they'll sit down with directors and shareholders, get a full understanding of the business, identify where the problems are, and then work out solutions to those problems. And I really want to reiterate that the first thought for any IP when they're approached by a distressed business is, how do we save that business? So liquidation doesn't automatically follow.
At Christie & Co, we saw a material rise in 2023 of the number of businesses that we were advising on selling and valuing that were deemed as distressed. What key factors would you say have led to that general rise in business distress and failure? And what's R3's view on the level and type of insolvency we'll see during the course of 2024?
Well, we know that creditor pressure is one of the key drivers behind company insolvencies, and creditors are taking a much harder stance now than they have been in recent years, and that includes HMRC. HMRC had shown unprecedented levels of forbearance during the pandemic, and their attitude has really hardened now. So tax debts that were deferred during the pandemic are due for payment. A lot of the time to pay agreements that were entered into earlier on have now come to an end, and directors are finding that agreements aren't so easy to reach now. Businesses are also operating with generally increased levels of financial debt, having taken on a lot more loans during the pandemic period. And a lot of businesses are really struggling actually to maintain trading as normal with those higher levels of bank debt. So they're also finding it much harder to refinance when they come to the end of their terms. And I think that's also tipping a lot of directors over the edge into seeking advice and understanding they can't carry on. And we've seen really terrible trading conditions for businesses for quite a large number of years. Demand's really down because of the consumer credit crisis. We're seeing that costs are still really quite high, including raw materials, fuel, wage demands are increasing, and the prospect of rate increases, which we know are coming in April, are really beginning to tip a lot of businesses over the edge. As we've said earlier on, in a fully functioning economy, a good insolvency process is vital, and there are always businesses that will fail for one reason or another, but we haven't been seeing that over recent years. So I think there's a certain level of catching up. Those businesses that would have gone through a process 2 years ago but didn't because the business support measures kept them going have now come to the end of their natural life and are being placed into insolvency. If you look at the statistics, 80% of formal appointments are always CVLs. They're a very efficient, effective process for directors to put a company through to wind it up at the end of their life. And I think we're going to continue to see a rise in liquidations because that's the most common process for most directors to go to. But as we see trading conditions start to improve, if we manage to avoid a recession next year and interest rates keep coming down, inflation comes back down, we will begin to see more opportunities for rescue procedures such as CVAs and administrations. So I think we'll see an uptick in those numbers next year as well.
Yeah, you mentioned CVLs, creditors' voluntary liquidations, and I think, if the news has been, there's loads of companies going into, some sort of insolvency process. If you analyse the numbers, what's been driving an increase in insolvencies is creditors' voluntary liquidations. And I think it's fair to say the majority of those are very small businesses that are asset light, that basically, perhaps one could argue the owners can't see a sustainable business for the future or haven't got the stomach to take the business forward. And so I think what's been driving the numbers, it would appear, is creditors' voluntary liquidations in the much smaller end of the market. Do you think as these pressures come through, these enduring pressures on businesses, paying back loans, inflationary pressures, input costs, all the things that we hear in the news are impacting on businesses, that will start to impact more on the mid-market and we'll see larger SMEs and mid-market companies coming under pressure, and what will be driving the insolvency numbers won't be just purely small SMEs through creditor voluntary liquidations?
I can tell you that the profession have been waiting for an increase in appointments since 2008.
Yes.
And unless a full-blown recession bites in 2024, I don't think we're going to see a wholesale rise in insolvency numbers of the sort that have been predicted in recent years. I think it's really clear that some sectors are struggling. We know that the construction industry, with the rise in interest rates, consumer demand is down there. Hospitality and retail have really suffered as people are going out less, they're shopping less. And we're also seeing lots of signs of distress in the care sector. I think a big problem there has been the inability to get staff and all the additional costs that go with pay rises and everything else. Creditors are still showing signs of forbearance though, and where firms engage early, there really is support, particularly from landlords and the clearing backs as well.
Of the stressed assets that Christie & Co disposed of in 2023, we saw a significant shift in the proportion of sale mandates we received due to insolvency rather than consensual processes. We attributed some of this to an increase in creditor action, notably by funders outside of the main clearing banks who were not as forbearing, and also a hardening stance from HMRC, and I know you mentioned that earlier. Do you think that we will see more aggressive creditor action going forward, and will this include the main clearing banks getting tougher?
I think clearing banks are very much more willing to take a consensual and longer term view, so they will bend over backwards to support the businesses that they lend to. And for them, stepping in and taking enforcement action is very much seen as a last resort. Yes. Having said that, the further through the difficult trading conditions we get, the more likely we are to see businesses having run out of options. And I don't think the clearing banks are shy of taking enforcement action, but they really do want the message to be that it's a last resort for them, it's not the first resort.
And do you think there'll be more of an opportunity to rescue mid-market businesses rather than liquidate them? I mean, if you obviously look at mid-market businesses as opposed to, we mentioned before, the smaller businesses where the zombie-style companies where, they're the first fence fallers, they fall first because they are the weakest companies. With the mid-market companies, there's going to be more options to rescue those businesses rather than liquidate them.
So the predictions are that interest rates will probably stay the same for a little bit but come down slightly, and inflation will definitely come down a little bit further, maybe not quite to the 2% that the Bank of England would like. That gives businesses more scope for looking at rescue and options like CVAs or trading administrations, which really do need the company to be trading and making a profit so that you can have surplus funds to put back into the business and repay creditors with.
And in terms of the different rescue options, you mentioned CVAs, administrations. With the restructuring plan, that's a relatively new tool that's been introduced to the toolkit of insolvency practitioners. How successful have they been? Is it a little bit early to say? What's been the extent of the use of them?
Well, we've seen 22 restructuring plans being registered at Companies House to date, and I think it's a little bit too early to talk about whether they are successful as a tool, because they have been used in quite a variety of different ways and processes. I think one of the successes of the restructuring plan that we don't see in the statistics is that actually they're quite a good bargaining tool. So they're quite a good option for companies to talk to their creditors to say, we are in distress, we do need to refinance, reorganise. Can we have a discussion about how we can do that consensually? The restructuring plans that we've had to date have been linked to very large businesses, and they've also been associated with very high fees and a very long process to get them off the ground. For them to become much more widely used and also much more applicable to SME business-sized businesses, I think we really need to see some change in the way that they are used, some change in the perception of restructuring plans. So we need to be able to standardise the processes a little bit. And we also need to see both creditors getting comfortable with the process of a restructuring plan. It's very new. They are perceived as being very different to CVAs. And I think a lot of creditors don't have the confidence yet to be able to look at a restructuring plan and feel that they can say yes to it, because they don't fully understand what's behind it. And also we've got to get insolvency practitioners comfortable with it as well. When you look back at CVAs when they first introduced, it took about 10 years for them to be really used in any great number.
So Caroline, predictions, and this may be a bit of an unfair question bearing in mind that the economic forecasters got it so wrong at the end of 2022 when they said going into 2023 we'd have 5 consecutive quarters of recession. So I really wanted to know what R3's view, the House view, or indeed your own view is what we're likely to see during the course of 2024 for growth, inflation and interest rate rises.
In 2023, the Bank of England reiterated their commitment to actually getting the inflation rate down rather than promoting business growth. If we have that as our starting point, I think we're going to continue into 2024 with low productivity. That's going to remain a real issue. But I don't think it's going to be quite bad enough to tip us into a formal recession. During 2023, inflation peaked at 11.1%, and by the end of the year it came down to a low of 4.6%. I think inflation isn't going to come down during 2024 all the way down to the Bank of England 2% target, but maybe by the end of the year it will be around 3%. And in terms of interest rates, well, they have been coming down gradually, but I don't think we're going to see a large fall in interest rates during 2024. I think probably they're going to hover around the 4.5% mark by the end of the year. But I come from an era where I can remember having a 15% mortgage rate. So for me, 4.5% still seems fairly low. The CEBR, the Centre for Economics and Business Research, are predicting that during 2024 there will be 7,000 business failures a quarter during the year, which sounds like a very large number, but if you compare it to the insolvency numbers for this year and previously, it's not actually too far out of line than what we've seen previously.
I think one of the things we've seen with some of the distressed businesses that we've had coming through our network this year, the cost of capital has started to have a real impact. I think if people are trying to refinance as well, obviously when you look at restructuring a business and looking at turnaround strategies, one of the things is often to restructure the debt, and I think that's been quite challenging this year. If somebody can't restructure, then the only alternative is exit. So I think we may see a situation where we'll see more people exiting because they can't refinance because of the cost of capital, which may mean that we'll see a rise in insolvencies for that reason as well. I mean, would you concur with that?
I think I would. And if you look at the Companies House data, the average age of a business at the moment is 8.5 years. So you've got businesses and finance teams that have never had to deal with anything other than easily available and cheap finance. and they've never had to deal with rising interest rates. They've never had to deal with finance being harder to get as well. And I think that's really going to impact a lot of businesses, because the finance teams just haven't got the experience to see the businesses through difficult periods like that. And you mentioned earlier on about directors being tired. I think there are a lot of business owners and directors that have struggled through the last 4 years, and it takes a lot of perseverance and patience and dedication to put a company through a rescue procedure.
If you haven't got the stomach for it anymore, what a lot of business owners were saying, what's the point in working just to pay off the bank?
Yeah.
There's not much else to come out of the business for us, not much upside.
No, that's right. And there isn't a lot of opportunities for selling businesses at the moment either. I think that coming out of the pandemic, there was a big rush to buy those businesses that had really flown during the pandemic, and the businesses that had shown perseverance and forbearance and had stood up to the challenges. I think there was a very, very big market for investing in those sorts of businesses. But the ones that we're seeing now that are still facing financial distress and cannot see demand from customers coming back, who can't increase their prices in order to cover the increased costs, so the margins aren't there, I think they really are going to struggle to have an alternative other than just calling it a day.
I think now people are being a bit more speculative and holding back and just seeing where it might go next year. And that's obviously, may dampen deal activity to some degree until people feel we've reached the bottom of the trough, and there's a good opportunity to buy these businesses at the right price. What message would you give to businesses worried about their finances going into 2024?
I think my key message is to seek early advice and follow it. If you seek advice, it doesn't automatically mean that your company will end up in liquidation. There are lots of reasons for businesses ending up in financial distress. You could have lost a key member of staff. You could have had a rapid expansion of business operations, and they're all very positive reasons for finding yourself a bit stretched. You really need to understand your cash flow, be looking at it regularly, recognise that if you can't pay HMRC or your other creditors, then you need to start looking 3 months ahead, 6 months ahead, and get advice now. The thing to remember is that by seeking early advice, you give yourselves options, and the more options you have, the more chance there is that an insolvency practitioner or other restructuring advisor will be able to come up with a solution that saves the business, saves jobs, and puts you back onto a secure financial footing. But if poor management is the issue, refinancing on its own is not going to change the underlying business problems. So you need to be willing to look a little bit broader than just finance. And finally, if you are going to seek advice, please do seek it from a regulated, trusted source. The R3 website is a very good place to start. There's a very easy find a member search there, which will tell you who's in your area. It will give you 2 or 3 options so that you can go and get a range of advice. We also have guides for creditors, so that if you are a creditor of a business that isn't paying you, or you've received a notice of a creditors meeting for an administration or liquidation, you can go into our website, download guides, and better inform yourself about what's going on.
Excellent. Caroline, wise words. Thank you very much for talking to us. It's been really interesting.
Thank you very much for inviting me.